Hey there. Thanks for tuning in to the Intellectual Investor Podcast. This is a special episode, Vitaly's interview with the Value Perspective Podcast. If you're more the reading type, you can read this article and subscribe to receive more at contrarianedge.com or through the link in this episode's show notes at investor.fm. Vitaly's interview with Value Perspective Podcast, written by Vitaliy Katsenelson and read by Elliot. Vitaliy recently had the pleasure to be a guest on the Value Perspective podcast by Schroders. In this wide-ranging conversation, Vitaliy talks about how he discovers mental models, the risks of linear thinking, and shares an embarrassing story about his time in Italy. Enjoy.
Welcome to the Value Perspective podcast on decision making. We're a group of value investors working together on the global value team here at Schroders. As investors, we have to tackle decision making in uncertain environments every day. In this podcast series, we speak to people from other walks of life who also share the challenge of making decisions in complex and uncertain environments. We cover topics such as how to think in probabilities, tools for overcoming psychological biases, and how we can learn and improve decision making in complex environments. We hope you enjoy it.
This podcast is for investment professionals only. The value of investments and the income from them may go down as well as up, and investors may not get back the amounts originally invested. Past performance is not a guide to future performance. The information is not an offer, solicitation, or recommendation of any of the funds, services, or products, or to adopt any investment strategy.
Hi everyone, hope you're well. Our guest this week is Vitaliy Katsenelson. Vitaliy is an author and a value investor who has taught at the University of Colorado and has written articles for such publications like Barron's, the FT, Forbes, and Business Insider, alongside his own blog, Contrarian Edge. He's also the CEO and CIO of Investment Management Associates in Colorado. Juan and Vitaliy discuss the mental models that Vitaliy uses in his everyday practices, including Myopic Circles and the David and Goliath premise, which fans of Malcolm Gladwell may be familiar with. They also discuss how to integrate and communicate your decision-making processes, including how to make the processes not feel like a chore when used every day, and the importance of engaging with others so that they're involved in your decision-making processes and can help you to expose yourself to randomness. By the way of housekeeping, it is worth noting that we did record this episode in January of 2022. Juan and Vitaliy also discuss PE ratios in this episode. PE ratios, or price-to-earning ratios, is the ratio for valuing a company that measures its current share price relative to its earnings per share. PE ratios are essentially used by investors to determine the relative value of a company's shares in an apples-to-apples comparison. Enjoy.
Vitaliy Katsenelson, welcome to the Value Perspective. It's a pleasure to have you here.
Oh, it's my pleasure. Thank you, guys.
So I have to say, a little bit of background for our audience. We were introduced by email by our friend Ben Benesh, great investor Ben, and we were supposed to meet in Colorado just in the kind of Christmas end of year season, and I never made it to Colorado, unfortunately. So I'm going to apologize in public to you for missing our live coffee.
I accept your apology, and I think Ben is a phenomenal human being. And, I think COVID interrupted a lot of plans, for the last 2 years. So, that's expected.
Maybe for our audience and those that don't know you, can you please provide us with a little bit of background? Where did you grow up? How did you end up being a value investor?
So, as you can tell by my accent, I was born in Mississippi. No. Okay, I was born in Russia. I moved to the United States in 1991. So I lived here I live in Denver, Colorado. I lived here for 30 years. I have undergraduate and graduate degrees in finance. I'm a CFA, which means I'm a geek. I'm to make things even worse, I'm a value investing geek. I wrote a few investment books. The first one was called Active Value Investing. The second one was my first book, kind of simplified, called The Little Book of Sideways Markets. And those books are, especially the second one, a good summation of value investing should be. It's kind of my version of value investing. I run IMA, which is a value investment firm in Denver, and our clients are basically high net worth individuals. And most importantly, for your listeners, I write articles, and I write every single day. Well, with very few exceptions, but people work out every morning. I work out my brain every morning. I get up every morning and I write for about an hour to 2 hours, usually 2 hours every single day. And therefore, I maybe publish 30, 40 articles a year. It's kind of, once every 2 weeks or so, maybe, once a week sometimes. And I write about investing, classical music, and life. And so if you're a reader, your listeners can listen to those articles actually as a podcast on investor.fm, or they can go and read them on contrarianedge.com. So that's that kind of summation of me.
Yeah, because I was going to ask you, you also have a podcast that goes along with the blog.
Yes, and the podcast is unlike your podcast, which is a kind of a sophisticated machine. My podcast is a kind of I call it lazy man's podcast. I have basically there's another fellow who reads my articles to you, so it's almost like my articles on tape. So if you don't like reading my articles, or if you just want to listen to my articles while you're exercising, that's it. You just subscribe. That's and it's on investor.fm. It's called Intellectual Investor Podcast.
I've never been to Colorado, and it was going to be my first time there. What is like the investment community in Colorado and the value investor community in Colorado?
So the Colorado is home for Janus mutual funds, which is probably one of the largest investment employers here. And therefore, it's a lot more kind of growth. There's a lot of people who left Janus and started their own firms. So they're a little bit more growth oriented, but there's still some value investors. But there's probably, because of Janus, a larger predominance of growth investors here.
Do you feel that being far away from some of the main financial centers helps you as an investor in the way that you approach and think about any specific investment situation?
Oh, yes. I think if you live in New York, especially New York, the atmosphere becomes very acidic because it becomes this micro competition, who has a bigger wallet kind of thing. And I don't want to compare myself to Buffett, but one thing we have in common, and that's where it ends, is that we both very far away from Wall Street. And I think that's a big advantage because when you are constantly comparing your wallets to other people, then your focus shifts from investing to your KPIs, switch. And, I'm been in Denver, I just keep thinking about, investing as a long-term investor.
That's really interesting. This is a podcast that aims to understand what tools, mental models, frameworks are used by elite practitioners in different fields to help them improve their decision-making and deal with uncertainty. And that's pretty much the core of what we aim to understand. We are very interested in understanding from your side if there are any particular tools, from base rates to adapting probabilistic thinking or any other framework or models that you have incorporated as part of your process, not only as an investor, but to deal with day-to-day life.
Juan, this is such a great question. Thank you for that. I find that I need to simplify complex things. So my brain has a kind of very low-powered CPU, so I need to kind of simplify things to my level, to dumbify things. And a lot of times, mental models help me to take something that's complex and dumb it down. And so I constantly looking for mental models. And I really enjoy investing in life and in anything. So let me tell you about two mental models. I just wrote about this recently. We haven't published it. We haven't published about it. One I call Myopic Circles. Okay, so let me tell you about this one. We all live in our bubbles. If you think about so if I think about my friends, I don't have a single friend who smokes. Okay, And it's not because I don't want to be, friends with people who smoke. It just happens to be that my social demographic circles are people who are somewhat probably higher income, some more health, higher health conscious. And therefore, those people usually rarely smoke, right? So therefore, it's very easy for me to assume that nobody smokes, right? Because, well, everywhere I look, I don't see a single smoker, right? But then I have this relative who smokes. And if he looks at the people surrounding him, he finds that most people surrounding him smoke, right? So therefore, the interesting part, the overlap of my circle and his circle is probably going to be, is very little overlap. And the reason it's important to understand is that as investors, a lot of times our view is skewed by our surroundings, okay? So as an investor, I own tobacco stocks, for instance, right? So it's easy to assume that nobody, because I don't see anybody who smokes, that people don't smoke, except, I forget the number now, 14% of Americans smoke, and probably in Europe that number is even higher. So when you look at the world, you constantly have to mentally adjust. Is my view skewed by my surroundings? By the way, the same applies by vaccinations. I don't for instance, I'm vaccinated. Again, this is no judgment. By the way, there is zero judgment on smokers, vaccinated, but people who vaccinate, who don't vaccinate. But if I look around me, everybody, all my friends are vaccinated. The only ones who are not vaccinated, they have a very very specific reasons, okay? And so therefore, it's easy for me to assume that everybody is vaccinated. We know that's obviously not the case. And then people I know, and then if I look outside of my circle, that if I find a person who is not vaccinated because of their beliefs, then most likely those people are going to have, they will be surrounded by people who are not vaccinated. Again, there is zero judgment here, but it's just, we need to mentally understand that we need to make this mental adjustment that just because we do things in a certain way doesn't mean everybody does this. And then one way, I'm not going to mention the company name just because it's a very small company, but we were looking at a company that does money transfers between US and Mexico. And if you think about, when you and I think about money transfers, you think about PayPal or Zoom or whatever. But because you and I have checking accounts, you and I are mostly going to transfer money from within our country, and to another person who has the Venmo, whatever, Well, but there's a huge amount of money transfers happening between U.S. and Mexico, U.S. and Guatemala. And suddenly you discover that only 35% of Mexicans have checking accounts. And you have 2 or 3 million Mexicans who are in the United States illegally. That number maybe even higher. And therefore, these people, it's like when we were doing our research and we would go to those kiosks where people do money transfers, it's a world that I've never been exposed to. I don't carry cash. These people, this demographic operates on cash. They get paid usually in cash. And so exposing myself to that, to that world that I'm not familiar with was actually incredibly important for me. So because I understood actually, well, there is a huge, I forget the 100 billion, there is, I think 100 billion, I forget the number, I think $100 billion transferred between the US and Mexico every year, mostly going from US to Mexico. So that's the market I did not know exist. Anyway, that's one of the kind of mental models. We can talk about other ones too, but yeah.
Yeah, please, by all means. You mentioned that there were 2 mental models.
So another one is a David versus Goliath, which is the oldest mental model. It's as old as the Bible, right? Because I think it's in the Bible. But and I am still in this mental model completely from Malcolm Gladwell, because I think he wrote a book called David versus Goliath. And Gladwell's story, when we think about the story David versus Goliath, it's a triumph of the underdog, right? It's the celebration of underdog versus the giant. Well, Gladwell tells a very different story. The Goliath was, I forget, 6'8" or 7'3". This incredibly huge giant, a mutant almost. he had armor around him. And if you were to fight him one-on-one, there is no way you would win. Okay. In fact, like you had these two armies stuck in, the way the story goes, and I'm not going to do a great job describing it, but you had these two, the Israelis and the Philistines, kind of stuck, and the Philistine Philistine said basically, "Come and fight us, and whoever wins this fight, this is going to decide the battle." And so the Philistines said, send the Goliath, and Israelites, or Israelis, I'm not sure, Israelites or Israelis, they, like nobody wants to go fight Goliath. And this shepherd, David, he's like, okay, I'll go fight him. And a king gives him a sword, and David says, I don't need your sword. And David was a shepherd, and he was very good at throwing rocks, like as a rock slinger. So you have this situation where you have this huge giant in armor, and then you have this little, 5'10" or 5'8", kind of shepherd, skinny shepherd, going to fight him. But what Goliath did not know that David was incredibly good at throwing rocks, as a slingshots, and Gladwell, consulted some physicists and figured out that when David was basically throwing the rock, using a slingshot, it basically was going with the speed of a bullet. So you had one guy came to the fight with a sword, another one came with a gun. Here is the key. If David chose to fight Goliath on Goliath's terms, he would lose. But he chose to fight him on David's terms. So a lot of times, somebody's advantage could be turned into disadvantage. Goliath's advantage of his armor made him a lot less mobile. Okay, and therefore that became his disadvantage. That turned into disadvantage because at a distance, David was so much more powerful because he had a gun, right? And so, how the story ends. Basically, David's throws the rock, hit Goliath in the temple. The Goliath, falls down. David comes to him and cuts off his head. But that is so. Every time I look at a company, or I look at my company, I'm trying to see, like when I run my company, we are a tiny little firm that are competing against the company. Like there is a Janus mutual funds that manages, I don't know, a few $100 billion, and we manage hundreds of millions of dollars. So how can I operate as David, as a company? I don't have the bureaucracy of David. I'm sorry, of Goliath. So how I don't have the bureaucracy of Goliath. Therefore, I can when you have a large company, you have a lot of politics. We don't have that, and we can keep going. I don't want to talk about my company, but let me apply this framework to the company I just discussed. That does money transfers. That company focuses just on Mexico and Guatemala corridor for money transfers. Okay, and because that's all they focus on, they can compete with giants. They're 1/10 the size of Western Union or some other giants, but because of their laser focus, because that they can provide much better service because they have agents who speak Spanish. They're in Mexico. When you call them, they pick up the phone in 4 seconds. And there's a lot of other things they do just because they're so focused. So for they realized that them being David, if they're focused, then actually they can fight Goliath, and Goliath could work against the Goliath. So those are just in the client letter I just wrote, I combined these two frameworks, the Myopic Circles and David versus Goliath, to describe how we were analyzing this company.
I really like that concept of Myopic Circle. I remember once the co-head of my team, Nick Kirech, saying that one should never extrapolate one's the things that one likes or the way that one behaves into the investment process. And I think that this discussion took place many years ago, discussing Bed Bath and Beyond, and someone said no one, and I think that someone have said this or frame it in absolute terms. No one goes today to a place to buy towels? And he would say, well, maybe you don't, but that doesn't mean that a segment of the population won't. Which I think that it's pretty much a little bit of what you're saying.
That's a bias. Yeah. So I think we have this bias, right? And I think we need to be aware of that.
One thing that we have touched upon on this podcast, and more specifically with Jake Taylor, he was making the point that we have all of these different tools that have been designed to help us become better decision makers, which should allow us to become better investors. And so the incorporation of base rates or the Myopic Circle or many of these different frameworks, but then they are very different to put together in a coherent way. And sometimes it's just hard from a behavioral point of view, from a personal point of view, to just do the homework. So he made this analogy that it's a little bit like going to the gym. We know that it's good for us to go to the gym and exercise ourselves on a daily basis, but somehow behaviorally we fail to do that. So the follow-up question I would have for you is, how do you incorporate all of these different mental models or frameworks or tools to make better decisions or remove the biases in a way that is efficient and just eliminates a little bit the complexity of having so many tools at hand?
That's a good question. By the way, Jake is phenomenal. He's a good friend. He's a phenomenal human being too. And he's very thoughtful about this stuff. I think just like you, excuse my pun, but I mentally keep those mental models in the back of my mind. Like, I'm not sure I have a good system that's, where I have a checklist, but if you've been doing investing for a long time, you see something and you're like, oh, this looks like that. But I'm not sure I'm very systematic about kind of a checklist of mental models. But one thing I do all the time, and I think writing is incredibly beneficial for me. Like, this is how I get benefit from writing. Is that when you write, you tell stories, and a lot of times you're looking for analogies. And if you want me to look at it, in mental models, a lot of times there are analogies, right? So when I write, it forces me to constantly look for mental models. And remember, I write every single day. And that's kind of my superpower, in the sense that, when I was born, I was given a very low IQ, and whatever boost I get from writing, that's kind of, brings my IQ to average now. So that's my superpower. And that's how I see I discover mental models probably more often than others, just because I write.
When you're writing on a daily basis, are you keeping a diary of what's happening or decisions that you've made in the past and how they evolve, or you're just putting thoughts into paper and things that you will kind of review over time? But it's just like a collage of ideas.
Yeah, it's good. So I tried very hard to write a journal, and I think an average person should do a daily journal. But the problem is, it's very difficult for me to do this because I write about so many different things all the time. Then I'm constantly, daily journal requires this discipline, and I have this excitement to write about other things that always conflict with daily journal writing. So I write about things I'm kind of want to think through. Like, if somebody asks me a question and I really want to find an answer for this question, the way I find that answer is by writing. Because if you think about writing, is basically what it is. It's a forced connection between your conscious and subconscious mind. And everybody's subconscious mind is so much more powerful than conscious mind. And therefore, writing kind of, instead of using iPhone to compute, to come up with ideas, I'm using AWS, or kind of, my subconscious mind, to analyze ideas. So that's what writing does for me. And so I do it daily, and I write about things I'm interested in. And a lot of times I write things and they never make it into articles. And then I might come back to them 6 months later, and then it turns into an article, something.
I heard you recently make the point that when screening for ideas, it's important to expose yourself to randomness. And I found that line very thought-provoking, among others, because on this podcast we had Maria Konikova, and she talked a lot about the dark side of variance and how you needed to expose yourself to the dark side of variance as well. And so why is this so powerful, and what needs to be incorporated within your emotional, psychological, and mental process to successfully take advantage of this? Because randomness tends to scare people. You don't feel comfortable being exposed to random events.
It's a very good question. I approach investing as a very creative process. Like I know, like you don't look at value investing and think of him as being an artist, but there is two parts to investing. There is a kind of analytical part and creative part, and they kind of meet somewhere in the middle. Because if you were just doing analysis, then you kind of turn into software, like in a very. And if you think only in numbers and don't look at the soft side, then you might as well be, because you'll be competing with computers, and computers will outsmart you any day. They'll do computation better. So there's a lot of creativity in investing, as well as just be able to analyze stuff. And I would argue mental models that probably belong to the creativity side of creative side of investing. What you think about just for a second, like when I talked about David versus Goliath, I was reading Gladwell's book not because I was looking for a mental model. I was reading because it was interesting. So by doing it, I exposed myself to something that lies outside of investing, completely outside of investing. And then I was able to turn this idea that lies completely outside of investing into in a kind of it's a life, but it's also invested mental model, right? So exposing yourself to randomness helps you to kind of build this mental model. I can approach it from a mental model perspective. Helps you to build this mental models, because a lot of times you bring this mental models from the world that are completely outside of investing. Like the Myopic Circles. I mean, I thought of this when I was thinking about the vaccinations. How come I don't know anybody who's not vaccinated? That's how I came to that. So that's partial answer to your question. Another thing is that you just never know where ideas come from. Like I remember talking. I remember talking to a friend, and we ended up talking about shopping malls, and I'm like, well, actually, and I was thinking, well, actually, maybe the factory outlet may be a good investment, and that was it. This is a short conversation, and that was a throwaway idea, like throwaway thought, and then I ended up going into a rabbit hole of shopping malls and ended up spending a lot of time on our outlets, and we bought a stock. That was completely random, but be able to see that investing is not working on the factory for the fiat. It's not an idea per hour. It's not. The more you work, like the harder you work, the better your results are going to be. You live in this. You constantly in this world, where you're stuck between analytics and creativity, and and a lot of times I find that let me give you another thing I do every day. I go for a walk in the park for about an hour and a half. So if you look at my iPhone, you will see that every day I do at least 10,000 steps, which is good for my health. But also I do this because this is where my subconscious does the best thinking. I walk, I listen to music. Sometimes I listen to podcasts. A lot of times I just walk and sit on the bench and think. So that is myself exposing myself to randomness. So
I've been following you for many years, and I don't know when I made a note of this. I think that you were. At any point were you a columnist for Institutional Investor?
Oh yeah, no. I wrote a column for Institutional Investor for 7 years. I was the only outside columnist who wrote like a monthly column for them.
Okay, so I think I got this from there. And so I'm going to actually read what the note that I took many years ago. This was like at least more than 5 years ago. Wow. And you said back then, just as it is easier to draw lines than to think in non-linear terms, it is simpler to buy stocks that have gone up a lot over the previous decade than to remain committed to the ones that have done nothing. However, linearity is for suckers. Success in investing comes from being able to see not what is in front of you, but what is lurking just around the corner. I thought it was a very powerful line, and of course I made a note out of it. And what's interesting is this concept of linear thinking, because that's another bias. That's a tendency that we have to protect ourselves, to sometimes make shortcuts and make certain decisions and extrapolate into the future, things that maybe should not be extrapolated into the future. And so I was wondering, do you think that you were born to avoid linear thinking, or you have trained yourself in time to avoid it?
That's a great question. Well, so I'm always questioning myself how much I've been born in Russia had impact on me as a human being. And I have this, when you read my writing and you sense the sarcasm, I think that's my Russian sarcasm that comes out. But the funny part is I'm 48 years old, and I lived in the United States for 2/3 of my life. And if you actually adjust for the fact that probably the first 8 years of your life, you probably don't remember anything, then arguably I lived here for 80% of my life. So, but there was still so when I let me give you probably one of the best examples of linear thinking where it was very dangerous. In 2008 financial crisis or housing bubble. At the time, if you look at the housing data going back as far as it went, maybe 40, 50 years before, housing prices never declined nationwide. And that's the key word, nationwide. So if you were in a rating agency or bank or any financial player, you would have looked at this data and said, if I take a house from Wisconsin and a house from Alabama and an apartment in New York, and I put them together in one portfolio, this portfolio, because of diversification, I'm very unlikely to lose money. If prices decline in Alabama, most likely they won't decline in New York or vice versa. So, and here's the interesting part. If everybody acts as if what happened in the past is kind of almost like a law. If it takes, because that was not a law, that it's not a law of physics that housing prices never decline nationwide. It's something we just have observed over the last 40, 50 years, right? If everybody confuses a kind of 40, 50 years of data with a law, then that's more, because of reflexivity, we're most likely going to violate that even more, because you're going to have you're going to build more houses, people are going to use more leverage, and then you have financial crisis happen. So, and the same thing, like when it comes to stocks, also, a lot of times people confuse price to earnings. If you think about price to earnings, by definition, it's a mean reverting metric. So and I brought a book, and my books were actually about the topic, right? Because whenever the stock price is going up because of price to earnings expansion, just solely because of that, or that's a big driver. When the price to earnings go to above average and starts going into stratosphere, at some point price to earnings stop going up and they decline. If you look at every market cycle, that's what happened. So this is why when you look at, and we kind of experienced this over the last 8 months. If you look at the ARC technology stocks, all those companies traded at 60 times revenues. And actually, it's kind of funny, they're down 50, 80%, and I looked at them, and now they traded only 30 times revenues, only in air quotes. And that's still not cheap. So it's very important to understand which metrics are mean revert, which ones don't. And I think that's, so when I look at the metrics, I always kind of mentally ask myself, is that a mean reverting metric or not?
I guess that connects with your myopic circle framework as well. The fact that if you don't look outside of what you are exposed to, then you might default more to think in linear terms rather than understand that maybe things are not linear.
Yeah, I remember, and I'm going to butcher it, but there were two money managers. Oh yeah, I know who they are. So I'm not going to mention names because they're good people, and I don't want to. So there were two money managers. One was kind of the king of the stock market, another one the king of a bond market. I'm not going to mention names. One had a great 2008, and one had a horrible 2008. And I think in part because one lived in California, another one lived on the East Coast. The one who lived in California saw the housing bubble that was much greater than the one on the East Coast. And they were kind of, so the one who blew up did not see it as much because, he looked around him and that probably did not see the housing prices being as crazy as the one who lived in, on the West Coast. It's kind of, and was exposed to the insanity of the housing bubble. So it would be, see what you and I just did? We married two different mental models together.
Yeah.
And that's how they become more powerful.
Yeah, it's interesting how you started your the answer to the last question. You made a reference to your roots in Russia because, well, I'm Colombian, and so that leads me to my next question, which is, I believe that we're shaped by the context and environment in which we grow up, and our understanding of risk and the perception about it is shaped by experiences very early in our lives. And so you Russia, as you have explained before, and then you migrated to the US. Do you believe that your understanding of risk is different because of your background and those very early experiences? Or is this way of thinking about risk or the different perception, would you consider that a weakness or a strength?
So it's kind of interesting. If if you grew up in the United States, mostly only good things happen to the United States, right? I mean, you have this country that's the largest economy in the world. You have this abundance of natural resources. You're surrounded by two oceans. You have two friendly neighbors. The polite one in the north and the happy one in the south. So it's so you have this kind of, it's almost like a micro bubble. I mean, it's a huge bubble, but it's an environment where since World War II, the United States only saw mostly good things happen to it. If you grew up in Latin America, that you had a very different experience, right? So it's a lot more different. It's like, let me give you an example where I fell into kind of non-Russian thinking, or not, like less skeptical thinking than I should have had. I'm embarrassed what I'm about to say. But that tells you about my, like this is so embarrassing.
Go for it.
Okay, so January, February 2020, this virus is blowing up in China. I am literally early February, I'm in Venice. And there's a lot of Chinese tourists in Venice. And this is like in a mental, I'm thinking, well, they might be infected, but like, this is, again, I'm so embarrassed for this because this is just unfiltered thought. Now that I look at this thought, I'm like, my God, this is just such an idiotic thought. I'm like, well, if they're infected, I won't get infected because it's a Chinese problem. Again, just think about how idiotic that thought is. But my point is, like, if you kind of take it on a more thoughtful level, we looked, like, I remember a week later after I came to Denver from my trip to Europe, and a week before that, maybe 2 weeks before this, I was in Milan. And suddenly, I'm looking at TV, and suddenly Milan has been, the stores are empty. There was a wave of COVID going through Milan. And I realized I was just there 2 weeks ago. And at the time, I could not imagine that something like this could happen in Milan. And I also realized that most of us look at the coronavirus and we thought, the not smart ones like me, thought that this was a Chinese phenomenon only. And because every time it happened in the past, it never really came to the United States. Like, even the SARS, etc. This was mostly kind of, Asian phenomena. And so I bet if you lived in Asia and you read the news about, the COVID, in China, your reaction would be, very different than kind of, dumb American, I guess. I'm talking about myself here. But anyway, so that is like, that is where I guess so now I'm very aware of this flaw. Like, so now I'm very aware that we only think that bad things could happen somewhere else. And, and also, by the way, growing up in Russia, like, you become skeptical. In Soviet Russia, it was easy to become skeptical of the government or of the future because they gave you promises that it's a bright future, and it was never bright. It actually always gets worse. So now when I look, and I wrote a huge article about this, because now when you think about US dollar, for instance, if you lived in the United States for last, since 1940, if you was born anytime after World War II, you basically saw the kind of rise in dominance of US dollar, where it became global reserve currency. But again, so what we're going to do, we're just going to put a few mental models together. But the linear thinking that US dollar can only, will always going to be a reserve currency is dangerous, because as a country, we behave that it's a God-given right for us to have reserve currency. It's not. It's something you earn. And we earned it for good reasons, right? Because we were the strongest economy after World War II and all the aforementioned, all the things I said before. However, what happens, like, as we behave as if it's God, it's a God-given right, we have $30 trillion of debt, and we keep spending money. We keep spending money as if we can have $40 trillion, $50 trillion of debt. At some point, the world will look at us and say, okay, maybe U.S. is a stronger economy than you pick, but it's not as strong as it used to be in the past, and they will start allocating money away from U.S. dollar. It doesn't mean that we're going to stop overnight being a reserve currency, but you're going to start seeing kind of a basket allocation or something like that. So it's not going to be binary. And I think that's another thing. You want another mental model? I always catch myself of thinking, am I thinking in binary terms or nuanced terms? Okay, so when we talk about reserve currency, it's usually binary discussion, right? In other words, either we're reserve currency or not. But if you think about nuances, well, it doesn't have to work this way. Nuance thinking, it just will become less of a reserve currency. So anyway, so that's.
Yeah, I think that even Seth Klarman on his last letter, I haven't read it, but I've seen the commentary where he points to the risk that democracy is not a given, and people are taking it for granted in the US to a certain degree.
I just wrote, probably the best article I wrote last year. I wrote this article about, on December 4th, it was last year, was 30 years since, December 5th or 4th, 30 years that we came to the United States. And I wrote basically this article about my thoughts about America over the last 30 years. And, and the country has changed tremendously. I think the country, ironically, the longer I live here, the less I understand the country, because it has changed tremendously over the years. And we are taking democracy for granted now. We are taking freedom of speech for granted. We are becoming more tribal. And so, yes, I think democracy is, again, just like the reserve currency status. It's not God-given right. It's something you have to continue to, you can lose it. If you behave in a certain way, you can lose it over time.
Changing gears a little bit, something that we explore a lot in my team is how do you communicate with people? Many of these concepts, some of these frameworks, some of these tools they seem easy to understand, but they are very difficult to put in practice. And some of them are not so easy to understand. Like the whole thinking in probabilities, that's not something that comes very naturally to many people. And you have pointed out that you like this process of writing, and you're very good at it, by the way. And so I think that many people say that they understand the importance of having, say, for instance, long-term thinking and a focus on process over outcome and avoiding and filtering noise. Yet, when there are periods of underperformance or markets get choppy or just things get very volatile, even outside of markets, people tend to completely forget and ignore all of this. So how do you communicate to your current and future clients so that they understand and embrace many of these concepts?
It's a good question. As you have mentioned, I write. And I am, the beauty, actually, I just realized being a writer has such a great advantage. I'm a better writer than I'm a speaker. And because when I write, I get to polish. I have this flexibility to think about and weigh every single word. Okay? When you speak, you think for the most part in real time. Therefore, you don't have this ability. You don't have this, I don't have this luxury of carefully think about every single word that I'm going to put together and I'm going to say to you. But also, writing is a lot more scalable. I can write one letter, send it to all my clients, or I can have 250 conversations, which would take hours and hours and hours with my clients every quarter. And I would argue that so what I do 4 times a year, I write a letter to clients. I call them seasonal letters, not quarter letters. So this is an important distinction. Quarters kind of happen, like in our industry, quarters happen 15, you expect to get a quarter letter somewhere between the first day and the 2 weeks later when the quarter ends. The irony of this is that when most companies start reporting numbers, maybe a week or 2 weeks after the quarter ends. So I'd like to write about what happened to a portfolio after all my companies report the numbers. So I write these 27 to 35 page long letters. And in this letter, I try to bring my client as close as possible to their portfolio. Let me give you this analogy. I have this client. I had a meeting with one of my clients, and he was a retired pilot, like a airline pilot. And I was talking to him that I'm afraid of flying in the sense that I fly all the time. But I have this fear, like when you're on a plane and you're 7,000 feet or 15,000 feet in the air and it starts shaking, I become a little bit more religious, just because you're on this can that's so high up and this wind starts flapping. And he said, it's kind of funny. When I was a pilot, I was not afraid of these things, but now I'm a passenger, and I'm afraid of this too. And I realized this applies to investing as well, because when he was a pilot, he had all the information in front of him, and he had control. Now that he is a passenger on the plane, he doesn't have control. Even though intellectually he understands what's happening, because he doesn't have control, he's more nervous. Now, think about this. As an investor, when I buy a company, we spend tens, sometimes hundreds of hours doing research as a team on this company. So we understand the business very well. So when the stock price declines, we kind of have a good idea what the risks are, what the company is worth. For our clients, if they know nothing about it, it's just a ticker that is now worth 50% less than it was 3 months ago, right? So there would be just the passengers kind of sitting on the plane. When I tell them how we look at the business, how we value it, then I try to bring them as close as possible to the cockpit without them actually, flying the plane. So this is why, I find that my communication to clients is incredibly important. Let me take it a step further. Go to March and April 2020, when the market was, going down 10% a day or something like this. I went from communicating to clients once every 3 months to once a week. And we would just, and there would not be 27-page letters, but we were learning, we would basically update our thinking every week, because our thinking was changing because we were learning new information. And I would argue that, we reduce volatility of our clients' blood pressure tremendously just because of that. So the opposite. So in other words, instead of hiding under my desk and just kind of going quiet, we did that. We did the other way. We went the other way. You could argue we over communicated to clients, because when things are going well, nobody cares. It's when things go badly that's when things go bad. That's when your communication becomes important. And so, but here's the thing: in the good times, I still want my clients to read my letters, because over time, like if they read them in the good times, when the bad times come, they already know what they own, because they read my letters for a few years, and then they will panic less.
Okay. That's really interesting. You've talked in the past about the importance you subscribe today to management's quality. And I want to approach this question from a behavioral angle. So we know that many people, when they make it to the top, in business or otherwise, they tend to be very good at sales and building a narrative. And so every time you meet with anyone, there is a risk that you will get biased by their narrative, their story, how good they are at communicating their story. So how do you protect yourself from getting biased and allowing their narrative, good or bad, from shaping and impacting your decision-making?
That is a phenomenal question. Let me do a small plug. I just finished the book, new book. It's coming out in May, and it's called Soul in the Game. It's The Art of a Meaningful Life. And this book has absolutely nothing to do with investing. Not a single chapter in that book is about investing. And about 1/3 of the book is about Stoic philosophy. And so in ancient Rome, there was this group of people, not a group of people, there was this school of sophists. Like, the word sophisticated has the same root as sophist. And this was a school based. That was a school where they would teach kids or adults how to be very elegant speakers. But Stoics never liked them very much, because those people, that school taught people how to speak, but they did not teach them the morals. Usually the morals, the Stoic philosophy did. In fact, Stoics usually, they kind of took the opposite approach. They want to speak very efficiently and not try to amplify things, because a lot of times when we describe things, we all amplify it. And by the way, I'm guilty of that because I'm a writer. I write a lot. But instead of saying I'm having the worst day of my life, you can say, well, my portfolio is down 3%. Like, I'm just, so sophists would say, I'm having this incredibly horrible, whatever day of my life. Sophists would say, Stoics would say, oh, I'm down 3%. Okay. Now, what's important about this is that I always learned, after I learned about this, you're absolutely right. To become a CEO, one of the prerequisites, you have to be a good speaker. You have to be a sophist to some degree. Like, you can have sophist and stoic in the same body, or you can just be a sophist. So therefore, whenever I encounter somebody who is an incredibly good speaker, I become a lot more alarmed. But by the way, it doesn't mean that person is a charlatan. That's not the point. I try to distill it, to what the person say, to facts a lot more than I usually would. So, like when somebody says they're having this phenomenal year, I would say, okay, so maybe I'm like, let's look at the numbers. He's up 7%. Okay, but you see what I mean? Like, and I'm not gonna get political, I promise. But if you think about it, President Trump was a sophist. Like, he would use these big terms, and so if you wanted to be analytical when you listen to him, you probably wanted to go to this, kind of more stoic level and try to, break it up to basics, So he says, we have a great economy. Okay, well, GDP grew 3.2%. That's what I mean. So anyway, so when we analyze companies and I encounter somebody, and by the way, a lot of management learn how to cater to the value investing community. I see a lot of management team do this, and they use all the Buffett terms, and they quote Buffett every third sentence. And when I see this, I become a lot more like, first of all, it's a good thing that, if they truly believe this, that's one thing. If they just say this and don't believe this, that's something else. So I become more alarmed, and and I filtrate it more. I filtrate the speech more when that happens.
Vitaliy, we are coming to an end of our session, and we always ask our guests 2 questions. A book recommendation, it can be more than one, of course, and an example of a bad decision where you can identify the poor outcome from bad process rather than bad luck. And it doesn't really need to be invested related.
The books are easy, actually. I'll give you a couple books. One is Alchemy by Rory Sutherland, which is a phenomenal book. And especially I would recommend his audiobook because he reads it and he is a very, it's written extremely well. That's one book. Another book, which is a Stoic book, the Guide to the Good Life by William Irvin, and that is the book that turned me into Stoic philosophy. But I gotta make one caveat: when you start reading this book, skip the first 3 chapters because they are very technical. Start with chapter 4, and I think it's going to be much easier to read. Well, I think I just gave you the kind of I gave you my COVID story. When I looked at Chinese tourists and thought I cannot get COVID because I live in the United States. That's probably the dumbest decision I've made in 2020 because that's the most embarrassing one for sure. Let me stick to that one because I think I can I'm going to stick my embarrassment to just one per podcast.
That's perfectly fine. Vitaliy, thank you very much for your time. This was an absolute pleasure.
It was fun. Thank you so much. It was really good. Thank you.
Thank you for listening. Inflation has been on everyone's mind these days. If you enjoyed today's episode and want to hear Vitaliy's take on inflation, check out episodes 128, 129, and 140 of this podcast at investor.fm. Enjoy life and prosper.